Hello and welcome to this webinar, which forms part of the New Model Business Academy's Professional Development Programme for 2016. In order to complement the comprehensive face-to-face events programme, NMBA will be hosting a number of webinars throughout the year, which are designed to assist financial advice professionals with the application of their advice. NMBA has created a professional development framework, which not only includes technical knowledge, but also includes conduct and ethics, business development, practice management and personal development, all of which should form part of any individual's annual development programme. Each of the NMBA webinars for 2016 will cover at least one of these areas, therefore providing a wide range of varied content for members to use for their professional development. As the content for these webinars is designed to support the application of advice rather than being purely educational, it can be used for unstructured CPD if required. The title of this webinar is Everyone Take Cover. I'm Tom Hegarty, Managing Director of NMBA, and I'm joined by Jeremy Martin from Partnership. For most people, some form of life assurance is fundamental or a must-have part of financial planning, whether it's to cover a mortgage or potential inheritance tax liability, or simply to provide a lump sum or income to the family in a time of need. But there are clients who may find it difficult to access the products available from insurers. For some people in ill health, this can be a real problem, especially if they're declined cover outright on medical grounds. Ironically, these individuals may have a higher need for insurance as they carry the most risk of a claim. Often those in ill health can be left particularly vulnerable because their medical situation may prohibit them from accessing mainstream products and services. Therefore, in addition to the hard facts, the FCA's research on vulnerable clients has to be taken into account. What have been identified as the risks? How can advisors ensure they've taken the appropriate steps to consider the issues raised and offer service to meet these circumstances? And this goes beyond protecting against the situations where clients are business owners, for example. The implication of a director or partner not obtaining cover can have a real impact. The scenario where business protection is needed to ensure the most appropriate distribution of shares or value can take place on death could be thwarted if funds are not available to the right people at the right time. In addition, the ongoing sustainability of a business where key person cover is not provided could also be impacted. If the cover is needed for someone in ill health, approaching a specialist insurer could be the answer. However, there may be circumstances where a rated case may be too expensive in providing the ideal level of cover, but working on a premium budget basis could still provide a level of cover that would help a client's loved ones to a significant degree. From an advisor perspective, it's important to explore all avenues available, including specialist insurers if necessary, to ensure that all client circumstances have been taken into account. It's clear that a knowledge of which insurers and the types of conditions they cover is vitally important in ensuring that the client needs are met and business is not turned away unnecessarily. By viewing this session, advisors will be able to identify clients for whom a specialist insurer may be appropriate, recognise the need for non-mainstream products, and understand the application of specialist underwriting for business and personal cover. Jeremy Martin started his career with a specialist pensions office, NPI, 27 years ago before moving to Scottish Amicable Prudential, where he was very active in the pensions and care markets. Jeremy has a depth of experience in presenting to the IFA community, both for seminars and workshops. Prior to joining Partnership, he spent over 2 years at Just Retirement on the sales team, gaining valuable experience in the underwritten annuity market. More recently, with an increasing activity in the protection arena, Jeremy has added RO5 to his list of qualifications, which complements his CII diploma status. Okay, I'm going to now pass across to you, Jeremy, to go through the presentation.
Thank you very much, Tom, and hello everybody. I'm delighted that you're able to join us this morning. As Tom has said, we're going to take a look at the whole issue of protection, but just to get your brains going, I thought I'd ask you to mentally think of something at this moment in terms of your client bank. Think about your clients and think about how many of those clients are healthy and perhaps how many are unhealthy. And indeed, has there been a significant change in the relationship between the healthy and the unhealthy as time travels on? Because I am betting that many of you will find that you have a mix of clients with a mix of state of health, because hey, that's human nature, I guess. So with that in mind, we're going to take a look at this whole area of protection, and particularly look at some of those areas that Tom was alluded to in the learning objectives that he read out, and particularly think about also vulnerable clients from the FCA's perspective and the interrelationship and the interaction between that and what we're talking about today in terms of protection. And what I would like to do is just draw your attention to other webinars that we have done in conjunction with NMBA, particularly entitled Vulnerability in the System, and also Get to be an Attorney. And I would urge you most right to take the time to have a look at those when it's convenient so to do. So without further ado, let's move along a little bit and then think about protection from a global perspective. It wouldn't be a presentation without some form of statistics in there to justify the environment, and particularly thinking about these statistics here that we've derived from Swiss Re, which looks at the what they call the mortality protection gap on a global basis. And the figure down at the left-hand side of your screen in US dollars is a huge figure of $86 trillion in terms of what is perceived to be the global protection gap, fundamentally an insufficiency of cover in the event of death of the primary breadwinner, and if, as you can see from that, no doubt we can consider it a great but underdeveloped market here, rife in terms of opportunity. Moving a little closer to home, let's just have a look at some of the reasons perhaps why that gap exists. And you'll see a slide here looking at various bars from the US, continental Europe, UK, Latin America in a color-coded perspective. And I particularly want to draw your attention to the sort of bluey-grey color, which is the second column in from the left in each of those particular towers, if I can call it that. And just have a little look at these, because the biggest or the tallest one is the one over to the left, where the reason for people not buying protection is frankly is people consider it too expensive, or they feel that they can't afford it. And we will perhaps explore some of that, and I will also bring a real life, a very sad real life situation to your attention a little bit later on. Further along there, it's quite interesting to note that if you look at column 2, the next one in from the left on the scale at the bottom there, it says procrastination is another great reason why people don't buy. They think they can deal with that on I'll get round to that tomorrow basis. Now, that happens to be prevalent in the US particularly, but you can just see how this slide works in terms of some of the reasons that it's given. And perhaps from the UK perspective, column number 3 or series of columns number 3 there in the middle, UK responses, over 20% have said, actually I don't feel as I need any form of cover. We would of course argue with your good selves that alongside your good selves that this is indeed a misconception, and that everybody needs some level of protection, because if they don't, then quite frankly they leave themselves in a vulnerable position, which is why we then have this particular slide here, which is bound up in FCA occasional paper number 8, called Consumer Vulnerability. Now, to be fair, this piece of work is one of a series of papers that the FCA has introduced to the marketplace for consideration and consumption, if you like. And in this particular one, we're about up to occasional paper number 17, I think it is, but this particular paper talks about consumer vulnerability, and it does so from various different angles across the financial services industry, right from full FTSE 100 companies, big banks and institutions, right the way through to intermediary practices, and for those that you know, Informed Choice and Nick Bamford, and I've seen him make many comments in the money marketing and trade press over the years. He's been a contributor to this particular report as well. And I'd just like to draw your attention to the definition that is given here, and it says a vulnerable client, or a vulnerable person rather, is someone who, due to their personal circumstances, is especially susceptible to detriment, particularly when a firm is not acting with appropriate levels of care. It's a very wide definition, as you can appreciate it, and I would actually just stress at this particular point, as it says here, it is not just the elderly who are vulnerable, and vulnerability can happen at any time. And people can go in and out of a sphere of vulnerability over their sort of life journey, many times potentially, depending upon what circumstances happen to them along that way. Now, some of the findings have been quite startling from this report, and this is an extraction, and incidentally, I would draw your attention, if you wish to have a look at this particular paper, there is also an accompanying video that goes with this, which is only about 4.5 minutes long, which is headed up by the former Chief Exec Martin Weekly, and it looks at this whole issue from a number of different angles, as I say, from financial institutions to individual intermediary practices. Nevertheless, some of the findings we'll have a look at now, the first one of which is this one here. In terms of savings, almost half of adults do not have enough savings to cover an unexpected bill of £300, according to the Money Advice Service. Now, I don't know about you, but that certainly is quite a startling statistic to my mind, particularly when we sort of cast our mind back to the days of doing FPC way back when, where there were recommendations about the amount of liquidity or cash people should keep in bank accounts for the what-ifs that happen in life's journey on a day-to-day or a weekly basis. So that's the first most startling statistic, and we need to think about where that leaves people in terms of vulnerability, and perhaps also consider how we might protect or against that. The second one here is equally startling, quite frankly, and it goes as follows. Just under half of UK adults have a numeracy attainment age of 11 or below. Now, I find that an absolutely extraordinary statistic, and one certainly worthy of our attention when we're thinking about how we help people with their financial challenges, which come in all shapes and sizes over the particular journey that they might have. We need to be mindful of how we talk to people about financial issues, whether it's protection or investment or pensions or whatever it happens to be, and we need to make sure that we're talking to people on a basis that is commensurate with their understanding of matters financial. And then the final one that we've just picked out here is in terms of how urgent is all of this stuff, particularly with protection in mind. And this one here, cancer, every 2 minutes someone in the UK is diagnosed with cancer, and by 2020 half of the UK population can expect to be diagnosed with cancer at some point in their lives. And having just lost a personal friend at 65, I can vouch for the validity and the seriousness of the impact that has had on those that remain behind for that. Nevertheless, there are other things that we can consider as well. And for example, financial shock, just sort of drilling down a little bit further here. These are statistics again from occasional paper number 8. And the first one is as follows. Over a third of adults have experienced a shock to their finances in the last 3 years. Now that shock can be in all different shapes, sizes and impacts, but obviously it's the impact that is pertinent to the individual or the family concerned that is the important factor here. And as I say, let's have a look at this. 21% have experienced a large drop in income, and it could be a loss of job, for example, or a change in hours, or a separation, or it could be sudden health problems that impact people, or quite frankly, it could be this here in terms, the last one here, in terms of bereavement. Now, just to bring that to shape or put that into some sort of perspective for you, I said I would give you an example, a recent example from my own situation or friendship group. Very sadly, we lost somebody called Donnie, I beg his pardon, a little while ago. He was only 49, very sadly passed away in front of his 11-year-old son on his son's birthday while playing football. If that wasn't tragic enough, Donnie had no form of life assurance because as 6'1" and some in the region of 19 stone, he wasn't able to procure any life assurance. However, his wife, his spouse, had life assurance to deal with such things as the mortgage. The problem was that life didn't turn out the way that they were hoping, and very, very sadly Donnie died, and you can imagine the sort of financial implications that has had on the surviving spouse, with not only a loss of income and their spouse and the tragedy that is, but also how does she go on to pay the mortgage. So Everyone Take Cover is the title of this presentation, and I really think that one brings it into focus for us all. But it could be anything as simple in terms of financial shock. Could be a boiler breaking or a car being broken up, or whatever it happens to be. On top of which, in terms of financial vulnerability, it's not a new thing. This is some extracts from a report that we looked at and covered, gosh, in about 2011 to 12, and what it was talking about here was that having paid work throughout the working life is not enough to ensure an escape from poverty in old age. And yes, poverty is highlighted there because actually it's a very emotive word. And indeed, the proportion of the working life spent in paid work is virtually immaterial to the chances of being in poverty in later life. The fact that you're working is almost irrelevant in terms of whether you're going to end up in a situation of poverty in later life. And we need to think about how do we handle that and particularly protect against it. One of the most obvious causes has been of this is the most consistent, as it says here, and significant trigger of poverty is the loss of a spouse for women. And again, I guess I refer to Donnie in that particular circumstance as well as simply the fact of the function of pension accumulation that has happened over the last 20, 30 years being more down the male route than the female. It's just a function of the way lifestyle has happened. But it's an issue of how do we prepare and protect people against these sorts of things. On top of which, the final points to come out of the occasional paper number 8 report, some of the findings were quite startling here. Products and systems that offered by financial institutions often streamlined customers, effectively boxed people off into particular routes which may or may not have been appropriate to them as such. The second one here is the response of frontline staff is crucial. Now, again, I would ask you to consider this report in its whole, because it was talking about the financial services industry as a whole, so there are various angles that it was looking at. And in this particular case, they cited, in fact used it in the video, they were talking about a lady who was diagnosed with cancer and had to ring her bank, and the initial response was from the bank was, well, is it terminal? Which I'm sure you agree is not perhaps the most tactful way of approaching this. Perhaps there is a need for, as it says here, some sort of sufficient or better training or different training to be involved in that. On top of which, we have such issues as poor interactions or inflexible systems. Again, the computer says no syndrome, if I can use that phrase, and indeed this one here in terms of overzealous implementation of rules. Now, for example, we have found anecdotally when dealing in the pension transfer sphere that it has been reported to us anecdotally that some providers perhaps are interpreting the transfer rules differently to others. I'm sure that those things have been ironed out now, but clearly we've had situations reported to us where a client might have had 2 pension pots, for example, of £20,000 a go, and effectively the provider has aggregated those and then concluded that actually because it's a figure of over £30,000, therefore transfer advice certification is needed for that, and as I'm sure you appreciate, that is not the case. So we need to think about some of the implementation rules and how that affects everybody. As a consequence of all this, the report finds that valuable customers may withdraw from the mainstream market, and also consumers tend to be overwhelmed by complex information. And again, I would refer you back to the scale slide on that one. If we've got under half of the UK adult population having a numeracy attainment age of 11 or below, how we actually present information and complexity of products is very, very and incredibly important to how people look at the financial services industry. Because as a consequence, if people, if they can't distinguish between promotional material and important messages, perhaps they opt to do nothing at all. Indeed, one of the other findings from this report was that to have an understanding of a bank current account required, in their estimation, a degree level education. And indeed, to understand a PPI cover, you needed a PhD, so a sort of bank account, bank loan, or PPI cover needed some substantial levels of education in order to grasp the understanding of these products. So I think it's a more can be done situation there. How does this all apply to protection? Well, in terms of TCF outcome number 4, I quote, where consumers receive advice, the advice is suitable and takes account of their circumstances, and I emphasize again, takes account of their circumstances, which is why we've referenced the vulnerable client piece so much. It could be their financial situation, it could be their educational situation, it could be their health, as in the case, very sadly, of Donny, for example there. How might that look? It could be a particular issue in terms of insuring impaired lives, which is, as a niche provider in this particular area, is obviously very close to our hearts. Is life cover more important if you have a serious medical condition? Well, I think the answer is yes. It's just as important to consider the needs in that particular aspect. The fact that somebody's had a declined application is perhaps cause for grave concern from a number of different areas, but we're thinking here particularly about protection and thinking about how we can perhaps help provide cover to those with severe medical conditions. And to that point, quite frankly, our underwriting experience allows us to help dramatically, and indeed I would also point out that now we are merged partnership and just retirement into JLP Group, our understanding of the impaired and the unhealthy lives, our data and understanding of that is, I would argue, second to none. And just to reiterate here, some further statistics for you. In the UK, some 2.9 million people have diabetes, according to Diabetes UK in 2012. Someone dies from a heart attack every 6 minutes, which is from the British Heart Foundation, and I've already referred to the occurrence of cancer every 2 minutes, which was referenced in the FCA report. So it is a serious UK-wide issue that we hope to try and help in providing opportunities and options for cover. With that in mind, where are we with this? What do we provide in this particular marketplace? And we can have a look at these slides here. We provide a level and decreasing term assurance. Now, to just draw your attention here, we initially, when we came into this market a number of years ago, were particularly concerned and offering cover for potentially for those with declined lives. But as you can see here from this top left box, we are now able to consider and potentially offer cover for impaired, which is, if you like, a sliding down the risk scale, so to speak. We also do whole of life for declined and healthy lives. Family income benefit as well for declined lives. And where that may be appropriate, you will know better than I would in terms of your client banks. And finally, gift into Vivos, both on a declined and a healthy life basis. So as I say, hopefully lots of options and opportunity to provide cover for those particularly that aren't quite as clean, squeaky clean and healthy as one might hope. With that in mind, let's just consider some of the things that we can cover as follows. That's not an exhaustive list, but it will give you some insight as to what we can consider and cover. But I'd like to draw your attention to a number of issues here. The first, just going straight from the top of the list there, in terms of alcohol abuse and dependency. Many of you will have noticed earlier this year in the summer that the recommended weekly intake of units of alcohol has changed. I'm not entirely sure that many in the UK have cottoned on to this, and what was a 21 units a week for male and 14 units a week for female as alcohol units consumed has now become 14 units per week, whether you are male or female. And interestingly, one other thing that we've known over the number of years is people have, it's escaped people's notice, the strength potentially of some of the alcohol that they are consuming. For example, in terms of wine over the years, the alcohol strength has increased from say in the 1970s, where a bottle might have had a unitary alcohol value of about 9%, up to a typical Southern Hemisphere wine perhaps now has 13.5 units of alcohol. Sorry, I beg your pardon, has about a 13.5% per volume strength, and a unitary alcohol value of around about 11 to 12 units. And again, for example, some of the stronger lagers that you can find, some of the well-known lagers have a unitary alcohol value of 3.2 units of alcohol per pint. And we need to put that in perspective against 14 users of alcohol. I'm really just trying to illustrate the point that there's an education piece that has to happen for many people as well. Just looking further down the list, atrial fibrillation there is an irregular heartbeat, which can potentially lead to blood clots and stroke or heart failure. Cancers we can consider. We need to look at what is going on there, for example, and we need to make sure that the client's willing to, or it's essential that they supply the information from their oncologist in the form of the relevant readings. And there are various scales available for different forms of cancer, whether it's a Gleason score or a Clark score for example, skin cancer. But I guess the most common one that is used, and which is available from the potential client's doctor or oncologist, is the TNM score, which is T for tumor size, N for the number of tumors, and M is metastasized, or how spread it is, or whether it's localized. And that's a very common one to look at. One final one to pick up there, cystic fibrosis. Again, it's an inherited disease, very, very troublesome and sad disease, which is mainly in the lungs and the pancreas. And we can consider all these, but as ever with everything, the more information that the clients are able to supply, the better are our chances of being able to give a considered option and opportunity to provide a quote for that. I would point out we can't do it in every case, as you would imagine, but I would add that whether you or I understand the medical terminologies and figures that come from people's doctors is in a way immaterial, because we have underwriters that do understand all that language and can hopefully provide some sort of quote option and cover options to clients. I did say it's not a universal cover option here that we can offer, and some of the things that we can't consider as follows. So, for example, conditions where no diagnosis has been made, not surprisingly, we need to consider are there further investigations going on. Where the body mass index is in excess of 60. And anybody that wants to have a look at that, there are a number of different charts around. For example, the British Heart Foundation, which you can put in your height and weight, and it will tell you in their language whether you are overweight, very overweight, healthy, or underweight. For anybody who wants to know, I'm considered borderline overweight to very overweight, but interesting enough, if I use a different scoring system from, I think it was Dudley, I think it was, they use the language of obesity in that, so perhaps that might be a reason why people don't want to consider these issues. But as I say, we can consider people with a body mass index below 60. Other areas we can't look at, dementia and, as you see, AIDS, except under certain circumstances, and it depends on those circumstances. Do speak to your normal point of contact about that. Some common cases to look at here we need to think about, just to give you some sort of food for thought. In terms of diabetes, I've given you some stats on that as well, but what we need to understand is what was the date of diagnosis. Again, what is the most recent HbA1c reading? And incidentally, we prefer that from the hospital rather than the GP practice. Whether it is type 1 or type 2, and very importantly here, are there any diabetic complications that we need to consider? Because as you're probably aware, diabetes has and the growing impact potentially into areas of the body, as referenced there in terms of retinopathy or kidney problems or neuropathy, which is something that a member of my family's has, and they can no longer feel their legs below the knees, and indeed all their hands, so they can't even write anymore. Any other medical conditions? So really, what is the ongoing impact to somebody's life, I guess, is probably the question we need to think about there. Another one, mental health. What type is it? Is it anxiety, depression, bipolar disorder, whatever? You will recall very recently the BBC, for example, ran a mental health awareness week, because it's an issue that's very prevalent in the UK at the moment, and we need to have information, as you can see there, the third bullet point down, how many suicide attempts potentially, if any, and any dates, and what's been going on in the last 5 years. These are really guidelines, they're not sort of hard and fast, it's really down to people's particular circumstances. And final one just to think about here is in terms of cardiovascular, what type of situation are we dealing with? Is it congestive, restrictive, so on and so forth? What are the symptoms currently, and what a treatment is going on either in the past or now? Again, it's one of those situations, what is the impact on somebody's ongoing life as at today? What is the impact on quality of life? All those sorts of questions that we need to factor in. Again, I reference the very sad case of Donnie in that respect. Just a couple of examples just to give you an idea of what we've been able to achieve here. This particular case study of Jenny, she's 34 years old, and we were talking about just over £67,500 worth of level term assurance on 28 years. A healthy premium is round about £15.34 a month. However, Jenny has a high BMI and therefore was struggling to get cover, and with a partnership we're able to offer cover at £39.92 a month, effectively a moderate case loading, as we would call it, of around 300%. Now, whether or not a client affords that, I'll come to in a moment. The second case to have a look at here is this one is Mark, a bit more severe. Just to give you a yardstick to measure against, Mark's 28 years old. He was looking for £97,000 of level term assurance over 15 years. The healthy premium was round about £13.81. Unfortunately, Mark is a long-term diabetic, and with reference to my previous slide about control and what's the ongoing situation, he has poor control over his condition with obvious impacts commensurate with that. Partnership, however, we're able to offer cover at £47.23 a month, which, yes, is a severe case loading, and for some people they might consider, well, okay, thanks for the cover, but ouch, we might consider that too expensive. And under those circumstances, what can we do? Well, we can also, as Tom right at the top of this presentation alluded to, we can consider benefit-based quotations and effectively ski downhill and ask the sort of questions: what level of premium is affordable? Can the client afford some cover, because some cover is better than none, as I'm sure you will agree. Even if the original cover level is not achieved, we can look at some sort of premium targeted basis, and as I say, some cover is better than none. What are the risks of in this whole area from a business perspective? Is it an opportunity loss? We're talking about business risk in terms of business written, but also business in terms of to the practice itself. So a business risk is defined as any matter or events, internal or external, which may impact upon achievement of business objectives, whatever they happen to be. So the question I guess we must ask is, how much income has been lost for clients that you thought were uninsurable? That's a question I guess I have to leave out there and let you ponder as you wish. Speaking of business, let's just turn now to a more business focus in terms of client businesses. It's not going to be an exhaustive presentation here, but just some food for thought for you on this. Let's think about key persons. Is it the chairman, marketing manager, computer specialist, managing director, sales manager, butcher, baker, candlestick maker, whatever? I'm not trying to be facetious, but some thought, as I'm sure you're aware, needs to be given as to who can be considered the key person in a particular business, and indeed what is the impact of losing said key person. Is it the loss of profit, the cost of training replacements, or indeed even of recruiting replacements? Now, the last time I asked somebody, for example, in the financial services industry, what was the cost of recruiting inbound to an insurance company, and it's a typical figure, I'm sure probably well out of date, but just to give you a feel for it, of around about 10% of salary and remuneration, just in terms of cost of recruiting, let alone issues of getting people up to speed in terms of what's going on in the business and the cash flow implications, and indeed the sort of personal contacts and loss of goodwill that's going on there. And the question we must ask is, what if they are deemed uninsurable by mainstream providers, these key people? What happens under those circumstances? Because it suddenly manifests itself as a substantial risk both to the individual and also to the business itself. And while we're talking about running a healthy business, as it quotes there, every business owner wants to ensure their business is a success, and this can mean putting in extra hours from time to time. But that does, it says there, have a detrimental effect, a negative impact, as it says at the bottom there, and some figures that came out of Simply Business was that there are in excess of 1 million small business owners who compromise the family and social life due to the pressure and impact of ROS. Perhaps, with that in mind, how can we think about sort of putting some sort of business protection in place? Some of the typical questions that we might think about here are as follows: are on death, who gets the director's share if you're manufacturing widgets or whatever it happens to be? Who's going to be the recipient of the controlling interest? If the shares go to the deceased spouse, who has no idea how to be interacting and running a business that manufactures widgets, then it obviously has a serious business impact, let alone conditions or issues around voting rights, so on and so forth. I've acknowledged that does the new shareholder have any sort of necessary level of expertise in that respect? Fundamentally, does ill health risk getting the right outcome in sort of sad circumstances? Are poor outcomes, I guess, a risk to the business? What happens if one life, for example, is not healthy in a trio of directors? How do we manage that? We'll look at a slightly simplified example in a moment. There's a question of are people uninformed? Do they think they cannot get cover? Again, I refer to the sad case of Donnie in that particular respect, and that was clearly the situation there. But again, bringing that into business perspective, if they think they can't get cover, what do they do about, for example, cross-option agreements? Do they only cover those that can be covered on a healthy life basis? We would argue that clearly that's not a good position to be in. Do we make sure that we have some cover rather than none? Otherwise the business itself is put at risk. But what we can do, as you can see in those bottom 2 points, is write the sort of healthy lives on what you might call a normal basis minus the impaired life, and perhaps write that particular policy on a separate basis. In other words, isolate and deal with each happenstance and circumstances appropriately. In terms of business protection, it might look something like this. Here we have an example of 3 directors. 2 are healthy and the green one there is perhaps potentially not so healthy, and the other figurine over there is the spouse in this particular example. So the directors take reciprocal policies under trust or life of another to the value of their shares, as you can see there. Then, sadly, the unhealthy director happens to pass away. What happens in this particular set of circumstances now? Well, on death of the director, the shares pass to the estate, often the spouse, and the life policy pays out to the other directors. And clearly what we need to achieve here is a swap over, if you like, of those particular issues in terms of the monetary value and the shares, so that the deceased spouse can try and put their life back together as best as possible, and the 2 remaining directors can press on and run their business, and therefore the cross-option agreement allows for either party to force the sale of shares to the remaining director, as you can see from my graphic there. In other words, the right money in the right hands at the right time. So, a slightly simplified example, but I trust it makes the point most strongly that we can help achieve potentially better levels of cover where perhaps one member of a business is not perhaps as healthy as they would like. How can partnership help with this? We have a number of technical guides for business protection and relevant life. We have trust forms, discretionary and bare trusts, flexible trusts, business trust, relevant life, so on and so forth, all sorts of assistive items of literature for you to perhaps get your hands on as you feel appropriate. Do contact your normal contact point within the organisation for those. Finally, just thinking about where we are with this, to bring this all together, if you like, the sort of call to action here is as follows. Do we have any clients who have had a past claim for critical illness, perhaps think they are no longer able to have cover, and we can sort of hope to sort of change people's mindset and perhaps offer cover depending upon the circumstances? Again, do we have any clients who have been told no to life cover, which is again why at the very beginning of this presentation I asked people to consider their client banks and for those, if you like, to do a mental state of health check on their clients within their client bank. Do we have any business owners who are in ill health, and perhaps we can now think about revisiting those and saying there is an opportunity here to help people achieve cover. And again, as that final one says, have you had to turn protection business away that you now think about revisiting? In other words, potentially opportunities to expand revenue across the piece. So hopefully that's given you some food for thought. We've now come complete circle here in terms of the learning outcomes. As you can see there, hopefully we've achieved those in terms of having a look at the FCA's vulnerable clients. We are a specialist insurer, and where that might, and giving you some examples of where we might be able to assist in helping you with your clients under certain circumstances there, and sort of where, if you like, non-mainstream products and their place in the protection universe. It just remains for me to say thank you very much for your attention this morning, and I will hand you back to Tom. Thank you.
Thank you very much, Jeremy, and hopefully you've all found that webinar useful, and you can use that session actually to improve the advice you deliver to your customers. If you have any feedback on the webinar, which we'd be delighted to have from you, or require any further information, contact Partnership directly, or alternatively contact NMBA by emailing us or contacting us by phone. On behalf of NMBA, I'd like to thank Jeremy and Partnership for supporting this session and sharing their expertise with us. Please look out for other NMBA webinars that will be available to you throughout the year, and thanks again for watching.